All right, hello, welcome everybody. Thanks for joining us today. This is Mark Soberman with NetPicks, and we're really looking forward to today's presentation. And this is going to be about the brand new NetPicks QuantiTrader. And we're real excited to have everybody here today. I'm also joined by a very special guest. Some of you even might know Jane from a number of years back. One of our original coaches and mentors at NetPicks, Jane Fox. So Jane, how are you doing today?
Just fine. How are you? I'm so glad to see everybody here. By the way, I am rather nervous. This is my first time doing something like this, so I want everybody to realize, just give me a little bit of I'm just rather nervous here. So okay.
You'll do fine. You'll do fine.
I know. I said everybody keeps on saying I'll do fine. I'll do fine. Yeah.
Exactly.
I know. Yes, I will.
She put the disclaimer out there. The good news is, and we always say this.
There's my disclaimer. Thanks, Mark.
Yeah, we never present ourselves as professional speakers, but we're always going to talk professionally about trading, and Jane can definitely do that. And you're going to learn an awful lot about quant trading and algorithmic trading, systemized automated trading. I know that's why a lot of you are here. And we've got a lot of great information to share with all of you during the presentation. All right, so let's go ahead and kick this off. Let's dive into the information. You know, what are we going to talk about, teach you, show you here in this workshop? Most of you really know who NetPicks is, so I won't have to spend too much time on that. We're going to go ahead and really break down the full, what we call the 411 on algorithmic trading. Really, I don't know if a lot of you know, but the markets in Wall Street has dramatically changed. The volume that's going quant-based trading or algorithmic trading. If we went back to the late 90s, early 2000s, when the market seemed to be really retail stock trader friendly, that's kind of gone. I mean, everything's really gone to the fact where a lot of firms actually co-locate. They put their computers right inside the exchanges, so they can literally cut off that final mile in order to quickly execute all their trades. And it's kind of excluded the retail trader. So a lot of what Jane really worked on over the last several years is how can I bring this technology, this approach that the hedge funds, the professionals, the pension funds are really doing phenomenally well with. Even the exchanges are making a killing off of all this volume. And it kind of seems like the retail trader got left in the dust. I mean, why do you think they don't split stocks like Google, Apple, etc. anymore? Why are these stocks over $1,000 these days? That never would have happened 10, 15 years ago. So that's a lot of what we're going to cover here, how we can really bring this to all of you. Since this is a true NetPicks family presentation, we haven't invited anybody from the outside. I don't need to cover this too much. You know, we've been around. We're going to be heading into our 18th year in January. We've got 180 countries where we have installed traders involved in our systems. From day one, we always worked with active individual investors. That has never changed. Our, the focus, we've never worked with professionals, brokers, etc. We've always been about you guys working with individual retail traders. Now, Jane, you heard from very briefly in the beginning. She gave you the quick introduction, made it clear that she wasn't a professional presenter. So who is Jane? And I wanted to kind of give you guys a little bit of information so when we bring her on and she answers questions, you guys will know more about her. Educated in economics, always very analytical. I would call her a workhorse workaholic. When she sees something that she loves, I mean, she's going to pour the time in. And that probably is one of the common characteristics of the entire NetPicks staff. You know, we're all a little bit of workaholics when it comes to trading. Very, very passionate about this. After she discovered online trading, like probably even a lot of you, she left the corporate world, began trading full-time. Spent 10 years analyzing and calling successful options trades. A lot of people may not know that, but she, for a number of years, was involved in making analysis and on the equity side and the options side. She actually became one of our original mentors and coaches back in 2006. That's why I say some of you in the audience probably even know her. And she was with us for a few years before she left NetPicks at the time to kind of pursue this project. And little did she know at that time where this would end up, and here we would be in 2013 launching the NetPicks QuantiTrader. But Jane's authored just countless number of articles on the markets, market internals, chart indicators. In fact, she wrote a lot of content for us back in the day. In 2002, she started to pursue automated systemized trading. And a lot of the reason is probably like a lot of you guys discovered, when trading is very subjective, it adds a huge level of complexity, and it's also very difficult sometimes to stick with a trade plan. It took her 10 years, like it always seems to pursue this holy grail. And a quote she actually said here recently to me, and I kind of wrote it down, is she said, "I actually found it. It was called quant trading. Quant trading is my holy grail." And Jane said that with incredible conviction, and I want that to stand out to all of you as we go through this, and why this might be that holy grail that I think all of us seek in trading. So really over the last 2 years, once she discovered it's quant trading, that was kind of the missing link for her. She spent about 2,000 hours, probably 2,000 hours plus. Her husband might think it's 4,000 hours, I don't know, and learning everything there is to know about quant trading, building the models, trading the portfolio, and now really here today for the first time ever, we're ready to share this knowledge with you. So very excited about that. Let's give you a little bit of an idea of what is quant trading, because you kind of maybe have heard this bantered about a little bit. Quantitative, or just think of it as algorithmic trading, uses data and a fixed algorithm as the basis for all trades. Quant trading is 100% mechanical. No emotions, no discretion, just a laser precise trading system. And in a few minutes, we're going to have Jane get on the mic and actually show you her run the model. It's pretty amazing because it's actually going to do literally about 6 years of analysis in a very short amount of time. I won't spoil it, but it's amazingly impressive. And just realize that it's all based upon a model and algorithm that we actually share with you. You guys will know what we're looking for in this model. So don't feel like it's going to be total black box, like you're going to have no idea why these stock picks are made and where they're made. And we're very much want to be transparent so you guys know. So the system is programmed to look at stock patterns, volume requirements, risk parameters to find the most successful trades day in and day out. I mean, realize there's thousands and thousands of stocks that we potentially could trade on a given day. Well, none of us can trade thousands and thousands of stocks on a given day. We have to figure out a way to boil it down to a very small set of stocks that are going to put the odds in our favor, that are going to fit the algorithm, and are going to give us the returns along with the acceptable drawdown that we want over the long term. Because the only way you're successful with stock trading is it has to work for not just a few days or a hot week. It has to be months, and it has to be years. Now, there's a number of different experts in the field, and I wanted to share a couple quotes from two of the experts, Daniel Kahneman, and I'm probably saying his name wrong. Jane will correct me a little bit later. Experts are uniformly inferior to algorithms in every domain that has a significant degree of uncertainty or unpredictability, ranging from deciding winners in football games to predicting longevity in cancer patients. One has to accept financial markets are no exception to the rule. So, by the way, who is this Daniel guy? Well, he's got a book called Thinking Fast and Slow. 809 reviews, which is kind of like Stephen King rankings. To get that many reviews on Amazon, you can see almost 5 stars. An amazing book, and that's why this is somebody that we should all listen to. And this might be a book you guys might even want to consider. By the way, if you have Kindle, $2.99 now, so pretty killer deal. I noticed there today, and you can see with those amazing reviews, well worth reading. But understand that again, building these type of models, you've got Howard Bandy, who also is a very well-known author, kind of one of the really leaders in the thinking on quant-based algorithmic trading. The universe of trading system is divided into two: having confidence and having faith. If you want quantifiable confidence, the kind of confidence that tells you whether or not to hit soft 17 at blackjack, whether or not to hit the blot in your inner table and backgammon, or whether or not to buy a new 52-week high, use quantitative analysis. Everything else is faith. Unfortunately, faith in trading seems to work temporarily for most people, and then it implodes. I'm sure all of you have traded very, very successfully for a short amount of time. We all have had those windows where we could do no wrong, but it never lasts. So the idea here, why has Wall Street in such a big way every single day gone to quant-based trading? When they can hire the brightest minds there are, why have they taken those brightest minds and instead have them build models? So think about that as we go through that. So who is killing it in quant trading? Almost all of the major players in hedge funds and pension funds use quantitative trading systems. They could do anything. They have access to every resource in the world. Again, ask yourself, why are they trading with this style? These managers deal in high volume trading while trading millions of shares while relying on the accuracy and profitability of these non-subjective methods. Up to 73% of the volume right now on Wall Street is based upon systems. So if institutional traders are killing it with quant trading, why can't the retail trader? All right? And why not? I mean, this is just kind of silly that we're watching the pros do this, and a lot of us are struggling, or we're turning over our money to a mutual fund that for some reason every year seems to underperform the S&P 500. I mean, if you have people making those subjective decisions, isn't it amazing how often mutual funds do not keep up with just straight index funds? Again, that should tell you something about subjective trading. So a lot of what we say with this is that we were going to go ahead and steal their technology. Now, I don't know, did we necessarily break in? Probably not to their facility. But even if it meant stealing their technology is the way that we looked at it. So, one thing that we were showing here, and I don't know if I can actually show the video, unfortunately. Oh, it's too bad. This was a kind of a funny video, but I can see that it's not embedded and it can't play over the GoToWeb. But we were determined to find a way to replicate the success, and I guess really not breaking into one of the hedge fund's facilities. So the way that we did that instead is did it the old-fashioned way, which is thousands of hours of work, years of effort, and never yielding until succeeding. So after building a model to analyze thousands of trades from the most successful high-volume funds, we really feel that we cracked the code. From there, we took the architecture and recoded it at the DNA level for a very particular subset of U.S. equity markets, and then tested and retested for years. This is not something that you can do with a push of a few buttons. This is not something that you can go ahead and suddenly have this kind of outcome for you. So this took an incredible length of time to come up with these models. So all of this came together to form the NetPicks QuantiTrader. So what is the NetPicks QuantiTrader? That's why all of you are here today. It's an online automated stock trading concierge service for the everyday Joe or Jane trading their own retail or retirement account. QuantiTrader provides signals generated from exceptionally designed and thoroughly tested algorithms. It takes the heavy analysis off your plate, as well as removing any emotions that can sabotage your successful trading. And I want to go into some details in a moment, what will happen and how little time you guys need to put in to manage these portfolios. But I think this is a great time, Jane, to hand it off to you so you can kind of show a little bit what goes into the models and building these stock selections. So let me go ahead and hand it off and let you jump in and show us some things.
Okay, so can everybody hear me?
Yeah, you're good.
Oh, good. Okay. First of all, what I wanted to show you was the software that I use. I could probably start way back further than this, but I don't think we really have enough time to do all that. So this is the software. It's called AmniBroker. And if anybody wants to go and research AmniBroker, you just go to amnibroker.com and you can find out everything you can about this particular software. This is the software that Howard Bandy uses, and Howard Bandy is one of the gurus in quant trading. So what I've done is I have gone and changed my retirement algorithm so I can show you some of the parameters that I will go and test and some of the parameters that I have optimized. So first of all, we'll show you the parameters that it goes into this algorithm. First of all, it is the percentage pullback, and we optimize on the price, and we filter on the volume. And then we have one set of logic that is days under a particular moving average. Then we have what the IBR is called the interbar range. And this is when a stock trades on or closes at a particular spot in its daily range. And the other is on how we exit. So first of all, what I would like to show is on how quickly I can actually do a back test on all these parameters. I'm just going to hit back test, and you want to watch right here where it says elapsed. I've got it. This will take 1.5 minutes in order to go through all the stocks from 2007. This is my to and from dates, 2007, and it's actually to today. The date is 2020, but there's only data up until yesterday, and so we'll go through all the dates from 2007 to December 16th, which was yesterday. And as I said, this will take 1.5 minutes. When this gets done, I will show you the results, and these are the actual results that I have on my website, or on the website, NetPicks QuantiTrader.com. And when this gets done, then I will change one of the parameters and show you how the results change. I would like to mention at this point that when I started looking at quant trading, and when I started looking at algorithms and the software that I needed to use, I knew that there would come a point where I knew I needed some help. And where I went to get that help to take me to the next level. And there are quite a few different people out there that I could have actually gone to, but there was one fellow down in Texas that I found. His name was Bruce, and hopefully Bruce is there. And if you are Bruce, I'd just like to give you a shout out, and if you could say hey. And this is the fellow that helped me take my algorithm from where I thought it was a good place, and he just took me about 2 steps further than that and made it to the point where it was not only good, but it was exceptional. Anyways, okay, so here is my list of trades. These are all the trades that my algorithm took from 2007 to yesterday. And here is the results. The annual return, I maybe have used a different set of parameters. Yes. So that was, okay, and I want to do just run that again, because what I had done is I had changed it to, I had changed the price from $2 to $5, and it just changed the results substantially. Anyways, so what I have here is I have a set of logic, and I have all the parameters on this logic. And when I run the back test, I can take each one of those parameters and I can optimize them on an entire range. Let's just take the price. And if I want to test everything from $2, say, to $10, and if I can test to see on how well the algorithm will work on all of these stocks from $2 to $10, $2, $3, $4, $5, all the way up to $10. And then it will give me a printout and show me which is the best price. So what I did is I went through every one of the parameters and I determined which was the best. Then I took each one of those parameters and ran them together to make sure that I had the best combination of all the parameters. And when I did that, then I took every one of the parameters, ran another optimization, so every one of the different levels of the parameters were compared against all of the other different parameters. Now, I can imagine you probably thinking that this would take a while. Well, yes, it took me, when I run something like this is called, like, not a walkthrough, but this is called an optimization. It usually takes me about anywhere between 8 to 10 hours. So I will start it at nighttime and let it run overnight. Anyways, okay, so here is my set of parameters. I have my percent pullback is 5, my price is $2, my volume filter is everything more than 350,000 on a 21-day moving average. Days under a particular moving average is 3, and the IBR is the interbar range, and I use an exit of Connor's RSI, and that's at a 50, and I'll maybe explain the M-bar limit later. Okay, so here is my results. First of all, I'd like you to take a look at this called the annual return, 45.61%. That is an annual return from 2007 to today of an annual return of 45%. Now, most people would say, wow, that is absolutely unbelievable. That is really, really good. I love it. Unfortunately, that is where you need to start. What you need to do from this point on is you need to start taking a look what's underneath the hood. The next thing that I look at is if the annual return is above 20 or more, then the next thing that I look at is what we call the maximum system drawdown. Maximum system drawdown is 15%. I've usually looked at my algorithms. I would like anything over 20% compounded annual return and anything less than 20% of a maximum system drawdown. This one's 15. Now, after you look at that, then you have to take a look at what we call expectancy. Expectancy is on this particular set of strategies is 6.82%. On your winners, and on your losers, it's minus 6.41%. So you are making more on your winners than you are in your losers. So those are just some of the evaluators that I use. Now, I guess I don't want to get into this too much because this is probably more than what we want to do at the webinar, but there's so many things that I want to show you. The other thing that this is what we call the equity curve of all of the trades that my algorithm took from 2007 to today. So you can see that's a pretty darn good looking equity curve, I must say so. The green line here is the 150-day moving average on the equity curve. Now, what I will do is what I call the circuit breaker. And when the equity gets below the moving average, like right here, I let the system continue to trade, but we move to cash. This was in August 2011. August 2011 was when the U.S. debt was degraded and the market just dived. And my algorithm took a big hit at that point, but at this point right here, we went to cash. And when you go to cash, that means then what you're doing is I've got your back, basically, is that if the equity gets below a certain level, then we go to cash, and then I have got an algorithm to get us back in again. And then at this point right here, just make this just a little bit bigger here. Then at this point right here is when I got back in again. Here, I went to cash again, and then I got back in, and here you see I went to cash again. But there's not very many places on this equity curve where I really had to go to cash. Now, Mark, I'm not sure, do you want me to just run one more test with a different parameter here? Do we have time to do that?
Well, let me point out a couple things. There's one thing that really stood out to me when you were showing this to me a little while back was the fact that the way this analysis runs, and it's actually one thing I didn't really think about, is how many companies throughout this period have been bought, merged, disappeared, and a lot of people when they do their back testing or their optimizations, it doesn't take into account the fact that there were all these companies, and you can see a lot of them here on the left, that no longer are even in existence, so you never get an accurate result or an accurate model. And one of the things you kind of told me and really emphasized was the fact that this type of data and this research analysis that you have covers every possibility back in 2007, not just what we see today as in existence back in 2007, correct?
Exactly, Mark, and that's called survivorship bias. This is one of the most important parts of when you are doing any kind of backtesting, that you have a database that does not have survivorship bias. Survivorship bias means that you are not testing the companies that have been delisted. And as you can see, every one of these companies that have got a date behind it, though it was delisted on that date. So there is this first one right here. If I would have had a database that had survivorship bias, I would have never backtested that particular stock. I would never backtested this stock. I would never backtested this one. So it's very important to make sure that when you're doing any kind of quant trading, backtesting, that you have to have a database that does not have survivorship bias. Of course, if you're only if you've got an algorithm that only tests like the S&P or any just one particular symbol, that doesn't matter. But if you are doing the U.S. equities and you are going back further than, maybe even a year, you absolutely need a database that does not have survivorship bias. And as you can see, let's just go down here, and we had a stock that was right there. ASTX was delisted in October of 2013. And actually, I actually traded that ASTX quite a bit. But if I had a database that had survivorship bias, I would have never, ever tested that. So
yeah,
thank you for bringing that up, Mark.
Yeah, I think that's just hugely important because I think, unfortunately, a lot of people build scans on really faulty data. You cannot trust that going forward. You're not going to get the same performance because you're missing a number of trades that may actually, in reality, have been selected rather than another stock that the faulty model is going to pick up on. I'm going to go ahead and grab it back here, and what we can do if people want to see the scan run again, or Jane change a parameter, like she could say, well, instead of $2 or higher in the model, what if we change it to $10 or higher in the model, and how would that impact the scans? And we, of course, can show you that, and the cool thing is we can show you tens of thousands of trades and stocks and everything in a minute and a half, but I want to kind of keep pressing forward here. So with the QuantiTrader, the way that the service works at a high level, designed specifically, like we mentioned, for a group of U.S. stocks, but it's not a small group of U.S. stocks, as you guys can see. It's literally even stocks that don't even exist anymore, as the case may be. This is all something that should take really 15 minutes or less per day. The results, which I'm going to get into here in a moment, you saw some of the potential results. I think you're going to be quite impressed with that. And realize that nothing with the NetPicks QuantiTrader is ever going to be speculative. It's never going to be subjective. It is always going to be, and I can say this firmly, 100% exact entry, exact exit, zero subjectivity, and no art of trading. In our day trading, in our Forex and futures, we have to use art of trading. 10% of it has to be, I guess you could argue, subjective. But one of the beauties of this is that there is 0% on the subjective side. It is 100% following the model. In addition, you saw Jane doing the retirement portfolio there. Maybe some of you guys noticed there was only longs. Well, that's what you'll have in a retirement account. In the margin portfolio, however, you can have longs and shorts. So that is also a benefit depending upon the structure of your account. And you may have a margin account and you might have a retirement account. So we've built two separate portfolios to account for those situations. All right, so the proof, like we say, is always in the pudding. So let's talk about some numbers. Annual return has averaged on the margin portfolio 60%. I also want to emphasize that we're using no margin. We're using a margin account, but we're using one-to-one leverage. You guys definitely could deploy some margin. Of course, if you deploy some margin, you will definitely make more, but your drawdown, which you'll have to understand, will also be higher. So it's a reward-risk type of thing that you need to decide. But I think one of the great things about the numbers you're seeing here is we built all this and we're presenting all the results without the use of any leverage. So if you started with a $25,000 account balance, 60% return, $15,000 in profit, takes you at the end of the year $40,000. And I'm going to show you, and a lot of you know the power of compounding. We'll talk about that in a moment. Now, the retirement portfolio is long only, annual return 47%. Using just one-to-one leverage, average profit percentage, 6.81%, max consecutive wins, as you guys can see there as well. These models can get very, very high. One of the most brilliant things that Jane built in, she showed you, was that circuit breaker, okay? Because there are always a time where a model is going to start to underperform. Again, like she says, she has your back, because when that starts happening, we'll just go to cash, and we'll intelligently get back into the market when the model is back on track. And in a future webinar, we'll even talk about what Jane does on a regular basis to make sure that the model is always in tune, to make sure that it's always going to be performing. So she's always looking at all the numbers just to make sure everything is tuned up. And she will tune up the algorithm on a regular basis, as does every Wall Street model. Nobody sits and trades the same thing forever. You have to go ahead and alter and modify because conditions do change. And you can see, of course, the nice returns there. Now, this is really where I start to get very, very excited. And this is where, I will go ahead and put my equity to work in these same portfolios, because look at the monthly percentage returns here. And I want to point out some things with this. One, of course, the consistency. The annual numbers are all great. You'll have some crazy outlier years, and then, of course, just some real consistent years. But you can see that the average month almost always dwarfs the average losing months, right? You have very few negative months. You're going to have some. It's just we can't avoid it, all right? It's just the reality. But they're very manageable, and they're very small. And this is really kind of key. So this is the margin portfolio, and all of this is available on our website, and you guys can dig into this deeper after the webinar. I'll share the URL with you, and you guys can do all kinds of great analysis on this. This is the retirement portfolio, just as solid of a story. If the markets have tons of volatility, like they did back in 2008, 2009, 2010, we're going to get outsized returns. But even if volatility is mild and small, you can see, like it's been the last couple of years, very good returns. And for the most part, looking at this and this is above what most of you are really looking for in your returns. And remember, this is all in 1-to-1 leverage. If you wanted to go ahead and do 1.5-to-1 leverage, accept a little bit bigger of a drawdown, but think about what that would mean to you. Keep in mind as well, during this same stretch of time, the S&P 500 worst drawdown was 53%. So here you are trading actively, having way above average returns, and actually our drawdowns are quite a bit lower than your typical index fund or typical buy and hold, which obviously crashed, as you know, several years ago and recovered since then. Another thing I want to show you is the profit distribution on the margin portfolio. Okay, notice, number one, like Jane said, 2 out of 3 trades tend to be profitable. So you're going to see a lot more on the profitable trades than on the losing trades. Okay. In addition, the bulk of our losing trades tend to be small percentage. There's always going to be something that happens, a news event that causes a big gap on a trade up to the favorable side, and it can also happen to the downside. So that's why we're not sitting here trading 100% of our portfolio, right, in one stock. We're typically splitting the portfolio up, let's just say, into 10 different positions or 7 different positions, and we'll talk about that a little bit as well. And then we're even developing a small account portfolio where minimum you'll have at least 5 positions. So no one trade, one stock is ever going to be the be-all, end-all. But you can see the distribution is very, very powerful here. Just as effective and strong on the retirement side. A lot more winners than losers. And again, we try to make sure that the losers tend to be small percentage. If it's not working in the model gets out quickly. And that's very, very important to controlling the drawdown like Jane showed you and that consistent success. Now, equity curves and compounding are a beautiful thing. This is why you want to stay with the QuantiTrader over the long term, because this is where it really starts to pay off. So if you would have started back at 25,000 in 2007, the percentage return's crazy, right? But that's all based upon the power of compounding. Okay, and you can see that little orange line, that's the circuit breaker. So anytime that would have fallen below that, like Jane mentioned, she'll go to cash. It could happen. It probably will happen. But if you start today, sometimes people look at equity curves and go, gosh, I wish I would have started back in 2007. Well, nothing we can do about that now. But at some point you have to start, and you have to start being consistent with it. The retirement account, it's just as compelling. And don't forget, this is long only. I'm pretty sure this probably blows away anything you guys have done with your mutual funds, with your stock trading, with your subjective trading. Again, you can see the consistency. I point you to the drawdown periods. You see it here, right? You see times where there have been losses. You see times where the market has, or the portfolio has clearly drawn down, where it's gone sideways, but not that often, right? And every single time it seems to take a step or two down. How many steps does it take to the upside? That's why you need to stay consistent to really be able to outperform. The person who trades in NetPicks QuantiTrader, who just follows it a few minutes per day and just sticks with it, and there's no reason you can't. I mean, you're literally given everything you need exactly. These are the kind of performance results we're going to be looking forward to in the go forward. So who should trade the Forex QuantiTrader? I know a lot of you here are trading Forex and futures even with our systems, but are interested in trading stocks. I'm the same way. I can only trade so much on the Forex and futures side. I actually have a much larger portfolio that's involved in stocks and mutual funds, and it's always going to be that way. Busy professionals, if you do not have time during the day, day trading just cannot happen. You just maybe don't even just get the whole thing on the Forex and futures side, don't want to use that kind of leverage. You've got a lot of leverage in one area, but you don't want to have the bulk of your your income, the bulk of your portfolio, you want it to be in something maybe more solid and stable, then that's going to be the investors and the mutual funds and the stocks. This is where you're going to want to be. I honestly think beginner level, we probably don't have anything at NetPicks that I would say a beginner can hit the ground running with. You guys know that. We always tell you that it's going to be a longer learning curve if you want to start with Trend Jumper or Keltner Bells. It just is. This is the only thing, and I've told some people this, where if I walked into a Starbucks and I looked around at the 20 people sitting down, maybe one of those 20, like a lot of you guys, would be qualified, right, to work with one of our normal day trading systems, active systems. However, if I walk into that same Starbucks, there's no reason that 20 out of 20 and the people behind the counter serving you couldn't trade the QuantiTrader. Okay, that's the difference. It is so straightforward and simple to follow. So what do you get? You get access to the NetPicks QuantiTrader membership site, daily update of the margin portfolio and the retirement portfolio, daily trade setups with exact entry criteria, and daily trade updates instructing you whether you should hold a trade or exit a trade. So look at the screen right here, and I hope it's not too hard to see. This is what you'll log in, and this was from 12/16. So this is literally a screenshot of the buys, and in some cases, in this case, only longs, which is not a surprise, right? The market has been going up, so no surprise the margin portfolio is all buys. But you will see shorts there as well when the market is probably in a bit more of a downturn. You saw here the first suggestion, or not suggestion, the first thing that you needed to do on Camtech is you need to sell it at the open. That's all you do, by the way. It's not complicated. Sell, market at open, and boom, you're done. Buy MITK, and there's a little number, calculate shares in the top right. You'll go ahead and click that. You'll put in your account size. It will tell you exactly how many shares to buy instantaneously. So you'll buy X amount of shares of MITK, but you'll only buy it at 5.25 limit price or better. Okay, that's another key thing with QuantiTrader. We never overpay. Okay, so if we don't get our price, we don't buy it. The retirement account, same thing. You see you've got to hold on CSUN. You've got to sell it open on the same. We happen to have the same pick, and you've got several recommendations there. In some cases, they're the same. In some cases, they're different. This is all you'll have to do each night, once a night. You'll get your buys. You'll get your sells. It takes you a few minutes, and you're done. That's it. You do not need to do anything the next day. Another thing that I'm going to show you in a moment is a really amazing portfolio worksheet that is also inside of your Owners Club, where you can actually put in your trades and track your results. I already told you it's going to do all the position sizing for you, so automatically it will tell you exactly to the share how much to buy, and you guys already know we've got the best support in the business. I mean, Jane will be standing by along with the rest of the team today. I should have probably told you early on. I think I forgot. You guys can ask questions throughout. I think a lot of you are. I've got Brian in the background, Ron in the background, Will in the background. I mean, you know that we're dedicated to making this work and getting everything answered for you guys. So take a look at this worksheet. What you're going to do is then you can enter your trades as they execute, including your commissions, all right, and it will start to calculate your profits and your equity curve. So this is your equity curve, right? This is your results over time, and you'll be able to have all these logged. You'll be able to have the chart, as you can see. This is, again, all built in. This is so slick. You guys are going to love this once you get into kind of the back office of QuantiTrader. So this is there for you guys as well. This is included, and you can do it on the margin portfolio and the retirement portfolio. And like I mentioned, we're going to be coming up with the small account portfolio as well. And you can track those independently, because some of you might be actually doing it, managing more than one portfolio. You may have a margin account. You may have a retirement account. All right, so very, very exciting. And you can see here, you can also then get the detail. If you want to go and see all the trades that you took, so these are all the trades that are taken. It's going to keep track of the percentage of profit, the profit per trade. It's going to keep track of the cumulative P&L, right? That's really important. It's not about just the one or two trades. All the stats that you guys need, you can download the data, as you can see, all right here. Very exciting to be able to do this and manage this. And that's when it gets it's going to be a lot of fun. Because when you start to do this for a few weeks and a few months, and these results start to really add up, this is going to be that thing that's just going to get you to be motivated and to continue on and to focus this way. And you're going to know that you're controlling everything, right? You're not relying on somebody else to do it for you. All right, so how is this going to work? Well, actually, it's really easy. So you don't have to spend any money. Okay, that's maybe the best news of all. There's no money that needs to be spent. We're going to give everybody a 2-week free trial This is the first time we're ever releasing QuantiTrader, so we're like, you know what? We know you guys trust us, but it's probably better just to give you 2 weeks on the house, let you go in there, let you see the picks. Tonight, you'll be able to see the picks for tomorrow. You can track them as you go. You can start trading them if you want. Take the 2 weeks on us. How much are we going to charge after that? $77. I mean, that's it for the service. It's on a month-to-month. There's no obligations, no contracts. You can, of course, cancel for any reason. But I'm going to emphasize this is the kind of system and service you need to stay with. Because to get the kind of results you guys saw, which really I think blows away what a lot of you even want, you need to go ahead and take the trades on a regular daily basis. That's all you need to do. And there's no discretion. It's all out there for you. No upfront costs, no obligations to continue. Go ahead and just take the 2-week trial and see what we're talking about. Now, I am not going to offer free trials forever. We figured we'd start today with 75. I've got about 700 people in here. I may need to bump the number a little bit. I'm not going to turn anybody away here during the free webinar that we're doing here. So you guys will all have access when I put the link up, but just go ahead and make sure you reserve your spot. The other thing I want to tell you is we are not going to stay at the same price. You guys will be grandfathered in at the $77 monthly price forever. So that means on the margin portfolio, the retirement portfolio, the small account portfolio. We've already built into this that we're going to go ahead and sell those separately. You guys will not be subject to that. So we may break it out and go, okay, it's $77 a month for the retirement, $77 for the margin. It may go to $97, it may go to $147. We don't know. We just need to start somewhere. So this is the best time to start, and how you do it and get started on the 2-week trial is netpicks.com/quant, and that's QUANT. You do need to type that into your browser. I definitely would suggest to do it now. If there's any kind of delay, the only thing I'm going to say, there's a lot of people here. You know, if it's kind of hanging a little bit, give it a little bit of time because there's probably a lot of people going in to sign up. But you just need to go to netpicks.com/quant, get the 2-week free trial. A couple other things I wanted to give you, and then we're going to go to a general Q&A, is there's a complete site at NetPicks QuantiTrader.com. You need to go to this site. It's amazing. Sign up for the trial first, and then go to the website because it has incredible information that Jane has put together on quant trading, system-based trading. It's got all the performance numbers I showed you in the screenshots. It's got a heck of a lot more detail, all the trade detail as well. It's really a lot of fun, actually, literally just to work around because you're going to get very excited. You're going to get very motivated, enthusiastic for what you guys are about to embark on with your trading. So let me do this. I've been babbling on and on. I want to bring Jane. I want to have you kind of come back on the mic and kind of give us any comments, and then also we're going to probably start doing some questions. So Jane, take it away.
Sure. Well, I don't know if I want to follow up on what you just said, Mark. Wow. You absolutely did get the essence of what QuantiTrader is all about. And I knew you would, and you did a fabulous job, and thank you very much. I'm not sure what else I can say other than one thing that Mark did talk about is that this is what you call long-term consistent profits. You can't just go in and start trading it, oh, well, I'm going to do it tonight. Well, maybe I'm not going to do it tomorrow night. Maybe I'll do it next week or something. You have to do this if you want the results that I'm showing you, the results that you can get. You have to do this every single night. It only takes 15 minutes, but you have a full-time job. This is taking care of business, taking care of a part-time job. This is what you call passive income. I'm not sure if any of you have ever heard of what we call passive income, but it is making money while you sleep, making money while you work. You put these trades on at night. They're all limit prices. Some of them will be filled. Most of them will not be filled. But when they get filled, then the next night you come and say, okay, I'm going to hold this one, I'm going to sell this one, I'm going to buy this one. 15 minutes, that's all it takes. And the next day, the market takes over. It is passive income while you work, not passive income while you sleep, passive income while you work. And I can't think of anything better than that. But you absolutely have to take every single trade. If you decide to do this, you have to go in and say, I'm going to do it. If you decide not to, then stop. It's not just, I'm just going to do it part-time. Okay.
No, that's great, Jane. I think that's why I'm so excited about it, because it fits so perfectly with what we do and kind of what we have preached here for 18 years at NetPicks, which is certainly taking control of your trading, but it doesn't interfere with anybody here who is doing some active trading, who is doing some day trading. The only thing it takes, like you mentioned, is just a few more minutes, and that's it. And you can continue to do everything else you're doing. So I know I've got a lot of people in here who do things like Trend Jumper and Keltner Bells and are very heavily involved in that, and that's great. This does not impact that at all. And a lot of you have asked us for this, honestly, for so long, because you're like, I'm using one part of what I have, but what about all this other? What can I do with the rest of my portfolio and the rest of my accounts? So that's very exciting. Let me go over some of the questions here. Ben, you were asking, quant trading is ultra short term. Is that what we're talking about for us retail traders? So like Jane mentioned, one great thing about this is not day trading. This is not being in and out in 23 seconds. By the way, 23 seconds is the average holding time on a lot of these models on Wall Street. That's why literally they move their computers into the exchange, because they can't be far away. They can't even be across the street. So that's impossible, right? Retail trader, again, you're excluded. You're not going to be able to trade that way. So the whole idea is using the technology, using the way the models are built, but in something a retail trader can actually do. None of us, I'm not going to be able to move my computer right into the New York Stock Exchange. So that's the beauty of this type of model. We don't have to trade that way. We're not looking for the one penny edge between the 15 different market makers that a typical quant hyperactive trading system is going to be doing. Let me see what else we've got here. Brian, let me bring you on real quick, because I know you've been answering, of course, a lot of the questions too, and there may be some, and I'll keep reading down here, that you specifically want us or Jane to answer right now.
Yeah, it's a typical, Mark. I did mark a few of them that I said Jane would answer at the end. There's a few common questions that I think we can answer that will kind of do a broad sweep of what I would call some common themes. First question, I'm going to list these off, so Jane, kind of keep track of these, and Mark, maybe you want to respond too. But one of the common questions was, how many trades per session can they expect? Okay, there's one. Two, what is the average risk per trade? Very common question. They want to know, obviously as traders, we want to know what our risk is when we put a trade on. So understanding that's important. And then maybe talk a little bit about how orders are placed. What time you're going to issue these setups, and how someone would act on those. And then along with that, common question was slippage and commission. Was that factored into the results?
Brian, maybe it's going to be hard to remember all these, so why don't we just do one at a time. So what's the first one? Just number of trades per day. I think number of trades. So Jane, what do you typically see on an average day? Number of trades they might potentially place.
I am looking at probably anywhere between 2, and the maximum in the retirement is 10, and the maximum in the margin is 7. So anywhere between 2 to 10 in the retirement and 2 to 7 in the margin.
Great. And realize we're really picky about what price we'll pay. Like Jane mentioned, we have no problem with that order never getting filled during the day. That is not a loss. That is not a problem. It means that we didn't get the value that we needed. So all that happens is that trade is over, and it may be recommended the next day, and you may see that recommendation again at the same price or a different price.
Every trade is placed at a limit order a percentage below the close of the signal day. Take, for example, Microsoft closes at $25. And if I am running an algorithm that has a percentage of 5%, it takes 5% below that $25, and that's where the limit order is the next day. We get filled on probably 20% of the stocks that we place. So what this does, though, is that your exposure is very low. So that means when we have a black swan event, and I'm not saying when, or I'm not saying if, I'm saying when, we have a black swan event, your chance of being in the market is only like 20% at the time when we have something, when we have some catastrophic event happen. Now, I know it doesn't happen all that often, but still, realizing that you are only exposing your money approximately 20% or less on each one of these portfolios.
I mean, and that's huge. You told me that the other day, and I was like, again, I was like, this is the reason I'm so excited about this, is the fact that, like you mentioned, those events, they're rarer, but it's, again, very reassuring to know that we're typically not going to have that broad-based exposure. I think another one of the questions I remember that Brian mentioned was on the risk side, when you place a trade, what is the average risk? I mean, you showed us, I think, that the average loss was about 6%, at least on one of the portfolios. That's the average. What are we potentially looking at? I mean, it can be certainly larger than that on an individual trade, correct?
When you have to, first of all, you have to define what risk is. And if you take expectancy, which is the amount that you can expect on a trade, if you go in expectancy on how much profit you can make on a trade, and I think on the margin it's like 2.3%. If you have a winner, you are expecting 6%, and if you have a loss, you have less than 6%. So what you want to take is you go back onto the NetPicks QuantiTrader.com, take a look at each one of the evaluators that I have for the entire 2007 to 2013 or any per year, and you can see what the expectancy of your risk is. The other thing that I would like to mention is that I do not use intraday stops. And I use what we call dynamic stops. All of my exits are dependent on what we call the Connors RSI. So when the Connors RSI on the retirement gets above 50 is when we close a position out. Except, of course, if you get in position and it continues to move down, you have to have some place where you say, uncle. My uncle is what we call the N bar. And that is, I will hold a position no longer than 5 days. So that means on the 6th day, you will get out. No matter what, doesn't matter what the Connors RSI is, no matter what, we will always get out on the 6th day. If I did not use the N bar, my results look a lot better. And this is hard to believe, but it is true. They look a lot better if I do not use an N-bar stop. The problem is there are some instances where I have had a trade that I have held on for 12 days. You have got a loss in front of your face for 12 days. I'm sorry, as a trader, I can't do that. There's just no way that I can handle a loss in front of my face for 12 days. So that's why I put the N-bar at 5 days on the retirement. Okay?
Yep, perfect. Thanks, Jane.
Sorry, I probably said a little bit more than I needed to on that one.
No, I mean, it's really important that they understand how all of this is been put together, and just I think how many things you built into this on the protection side, because as much as we're all into the returns, which are amazing, I know a lot of your focus is on how we control the downside and how we control drawdowns.
Absolutely, yeah, that is probably 75% of my focus is on how to control the downside.
Perfect. Brian, did we, was there another one? I have more questions that I'm going to cover here, but was there any other main ones?
Yeah, I've got a few other ones that were really common. One is, Jane, can this apply to options, and probably a little more advanced, but have you looked at that?
Possibly, but I have never done back testing on it, so I would never use options. If I can't back test it, I will not trade it. And I have not, it's very difficult to find a database where you can trade options because, of course, of the inherent issues that the options expire. So you have to be able to figure out how to you have to get a database that will give you that kind of data. And it was not something that I wanted to enter into, so that's why I stayed with equities. It was because it's something that I could quantify much easier than I could with options.
All right, and one last one that I have is was a common question. What's the minimum sized account someone can get started with?
That is a very good question. I would say that I have done all my back testing on 25,000, but there is I don't see why you couldn't do this on 5,000, because let's take the retirement account again. If you had 5,000, we allocate 10% per position, so that's $500. There is no stock that we trade that's more than $500, so you're at least going to get one position. Now, so the thing is, of course, then it's going to be much slower, but Mark and I were talking about maybe developing an algorithm that did 5 positions and allocating 20%. It's more risky, and so I'm not sure if that's what we will end up doing that or not. But I don't see why $5,000 couldn't work.
Yeah, it's really just going to be based upon the broker. A lot of the brokers, will say that they'll open a margin account for $5,000. There may be some that will do for less, and it's all just percentages. I mean, if you have a $25,000 account and 10% means you're going to put $2,500 in. If you have a $5,000 account, it means you're going to put $500 in. You're going to have the same percentage returns, drawdowns, etc. outside of the fact that you'll have, your costs, your commissions will be certainly a little higher of a percentage basis on the $5,000 account than the $10,000 or $25,000 account. So just be sure if you have a smaller account, do a little bit of commission shopping. Make sure that you feel that you're paying a very affordable commission.
Absolutely, Mark, because definitely with the smaller accounts, commissions do take a bigger chunk. So you want to have something that has got low commissions. I mean, nowadays, though, you can find brokerages that the commissions are just almost non-existent.
Exactly, that's what I was going to say. It's very easy to keep that down. Just make sure you're aware of that. There's a question from Alan. I don't know how much you want to get into this or not. When you run AmiBroker, what is your data set and what is the source of the data? I don't know if that's something that you want
good question. Very good question. I use what we call Norgate premium data out of Australia, and the reason that I use them is for, first of all, number one, they did not have survivorship bias. That was what my most important. Plus, they also had an API for AmiBroker. I could have used another one called CSI, but it didn't have an API for AmiBroker at the time, so Norgate was, and Norgate has been extremely, extremely good, extremely stable. And the other point that I'd like to make, though, is that Norgate does what we call an unverified version of their data. They will have it out by 1 hour after the market closes. They will have a verified version of it about 3 hours after the market closes. I will not do my scans until I get the verified version because there can be discrepancies. So I will not have the trades posted to the members only site to around 10 o'clock Eastern Standard. Now that seems kind of late, but you can also put the people that on the East Coast can put their trades on in the morning because the market doesn't open until 9:30. So I know 10 o'clock is rather late, but I needed to give myself that amount of time by the time I get the verified version from Norgate to the time I get my scans done. Plus also once I do my scans, then I have to have those verified as well. I have a verifier that takes, I do my scans, put them up, I put them so no one can see them, then I have someone verify them, and then they activate them. Okay?
Yep. A question that I've seen kind of asked different ways, and it's a good question, is obviously when you do optimization, which you have to do when you're building a system, and you have to base it on something, how do we ensure, or what do you do to make sure, number one, we're not over-optimized, or the famous curve fitting? And I know you've been trading this with your actual funds in real time for quite a while. So
for a year.
For a year, to give you the confidence that you feel the model will hold up, go forward.
Over-optimization definitely is an issue. So what that means is that right now, one of my biggest drawdowns on the retirement was in August 2011. So if I went back to August 2011, I thought, okay, now what could I have done to have avoided August 2011? I could have done this, I could have done that, I could have changed this parameter, I could change that parameter. And then how does that affect the rest of the data? How does that affect the rest of all of the trades? And I did fall into that a couple times, and then Bruce, out of my mentor from Texas, suggested, probably that's not a really good idea. That is part of trading. August 2011 was part of trading. These things happen. When you're in a trade and you have the U.S. debt downgraded, this old saying is there ain't nothing you can do about that. So you just have to, this is the kind of, you want to see in how well your algorithm what your algorithm did when you had this downgrade. And as you could, I showed you the spike down, and my algorithm regained that probably within the next week or so. Then the other part of the other part that I just kind of digressing a little bit is that the reason I went back to 2007 is because I wanted to make sure that I had the 2008 time frame and see how well my algorithm worked in that 2008 time frame to see if it was going to actually fall apart when we had the financial meltdown. So my algorithms go through low volatility, high volatility, bear markets, bull markets, and financial meltdowns, and they held up throughout all of them.
And you do, however we want to term it, tune the model or certainly keep it very connected to the overall performance. I mean, it's not like you will just never touch it, correct?
No. Every single month I do what we call an optimization. I optimize on the N bar, which is the number of days that I will allow a trade to exist, and on the amount, the pullback. The pullback, of course, very much depends on the volatility. If the volatility goes up, my pullbacks will go down. If the volatility goes down, my pullbacks will go up. So I want to make sure that my algorithms are in tune with the market, because you all know that volatility goes up and down and up and down, and my algorithms are going to be in tune with what the volatility is doing with the market.
Exactly.
And I do that once a month.
Yeah, I think everybody gets a little bit hung up on, and for a good reason. I completely understand it. On, we've all been obviously warned against, over optimization and curve fitting, and those are legitimate good points. But realize that every system in existence is built upon past data, right? You can't build something on future data, so you somehow have to build it and feel that it's going to put the odds in your favor and put the percentages there. And realize you're going to have to modify it at times. We do it, inside Premier Trader University. We do it even when we build trade plans. I mean, I've had Keltner Bells out there for years now, but the reality is, and those on that service know that on occasion, we have to go ahead and make some adjustments. Sometimes the smallest adjustments, just the size of the bars, but market conditions do change. And so that's the one key thing that that you've got us literally every month caretaking this and babysitting this, and we have our funds in there as well. So we're going to be very much on top of these type of issues, making sure that we're not over optimizing, but certainly realizing that yes, we're going to have to tweak some of the dials on a regular basis to keep the performance consistent.
Over-optimization is definitely an issue that I have addressed, and you can be rest assured that I have not over-optimized. You just take a look at August 2011, you can see that I have not over-optimized. The one other point that Brian brought up is slippage, and I wanted to address that. There is not such a thing as slippage in this system. I use limit orders. Like I'm using the Microsoft again. If you have Microsoft at $25, you're going to buy Microsoft tomorrow at $24.75. You're going to buy it at $24.75. I mean, there's just absolutely no slippage. Plus, also, I am using very large equities here with large volumes, so it's just I have never ever encountered slippage at all.
Yeah, that's a good point. On the scans, if you looked at Jane was using, not using, pink sheets and things that trade with very low volumes, you can get crazy, incredible results, but those aren't liquid stocks. So these are all going to be 350,000 shares or more per day over a set of time. I think it was 90 days. Is that what you had mentioned? I believe in the model. So that's a key thing. You'll have liquidity there, which is obviously important. Is it long only? Brian, go ahead.
The short part of the margin requirement is the margin portfolio is 7 positions, and I can have 7 longs, but I only have a maximum of 3 shorts. And the reason I did that, this was on the advice of Bruce, but he said he said he had a hard time sleeping if he would have 7 shorts, because the market always has an upward bias. We know that. The market always has an upward bias. So I have made that the algorithms will only have a maximum of 3 shorts, and those shorts have volume requirement of 4.9 million. That's on a 21-day moving average on the volume. It has 4.9 million. So they are very large stocks that we're shorting. The other point that I just thought I'd bring up.
That's a good point. I mean, it's important that you can actually get those trades off on the short side.
Right. So there definitely is volume. There is there is stock to borrow if you're going to short. I have once in the last year I have only had an issue where I was not able to borrow stock to short, but that was only happened once.
Yeah, and it will happen for everybody. But the right brokers tend to have enough inventory. But don't be surprised, like Jane said, if it does happen on occasion. But it should just be a rare instance. If not, it could be an inventory situation with your broker, and that might be a reason not to be there. David, where you asked, will we give results that include short trades? So when you look at the margin portfolio, that would include the shorts, but with Jane's strict criteria only, and then of course the retirement account would be long only. I'm just kind of going through questions here. Options and Forex, so we answered that question.
There was one question here, Mark says, what time is the email sent out each day? I don't send an email out each day. I will have the trades posted to the members only site by 10 o'clock Eastern Standard every single day. If I have an issue with any of the signals, if there is a mistake that I just didn't notice or something happened, or maybe if NPD data is down or whatever, I will have a way of emailing all of the members as to the issue. But other than that, you will go to the members only site after 10 o'clock Eastern Standard to get the trades for the next day.
Yeah, or log in the morning before markets open at 9:30.
Absolutely.
ETFs. This is all stocks. There's no ETFs in here, correct?
No. No, do not trade ETFs. I'm looking into an algorithm that will trade ETFs, but right now I've not had the time to do that. So, possibly in the future.
Yeah, right. I know it's always something that could be considered. I know there were questions on commission. I know Jane answered to Mark and a few other people. $3 a round trip was factored in. So there's definitely several questions on that. Let me keep going here.
Lots of questions on options, isn't there? Lots of people like to do options.
Some of these are definitely optionable, but like Jane mentioned, it wasn't built with that criteria. So there could be selections which do not trade options, or there could be selections where they only trade two contracts a day.
I would have a really hard time with trading options on this because it is not back tested for it. And like I said, I'm not going to trade anything that's not back tested, and it's very, very difficult to trade to back test options. And so I think that options is you can if you want, but you're not going to get the same kind of results that I'm looking at. Maybe better.
Yeah, for sure. Ben, talking about commission intensive, not really, because don't forget that one of the key things is we don't execute on a lot of the trades. Again, if we don't get our price, you don't pay a commission. So you may place the trade, but you will only pay the $3 or whatever it may be if you execute. Average number of days, like what's the holding period on the average trade, just in general?
Oh, if it's a winner, it's 1 day. 1 day, yeah. Average, I'm saying 2-3 days.
Okay.
If even that.
Sure.
Not long.
Yeah. So we're not looking. This isn't a buy and hold. This is looking to take advantage of a very specific situation, take advantage of a burst in price, and get out. So we're not doing a lot of trailing and a lot of all that type of thing. This is just looking to not fall in love with any one trade, to get what we need to get out, move on to the next set of setups, and you'll have them every day. So another nice thing about this is you will not be bored. You will not be waiting weeks and months on end for these setup. You're going to see trades being output virtually every day.
There is one thing that I'd like to mention, Mark. I know this is starting to get a little long, but there is something that has happened that to me on actually it happens a couple times a month, is if I get I'm going to go back to the Microsoft. If I have a limit order of 24.75 from Microsoft, and I go down and I get filled at 24.75, believe it or not, and then the market turns up. I mean, this is a really nice problem to have. Unfortunately, the software will only acknowledge that I have actually filled on a stock if it gets down to 24.74, 1 penny below the limit price. So here I have a stock that I've been filled, but my software says I do not have it been filled. I have it filled. This will happen to you. and it will happen to maybe 50% of the members, and the other 50% will not be filled, just depending on the broker that you use. So what I'm going to suggest, and I will put this up on my website, is that if that happens, get out the very next day to get yourself back in sync with the algorithm. But like I said, this happens to me on a regular basis. I get filled at the market lows. Nice problem to have, I must admit, but it is something that I just thought I'd mention to people that are here already.
No, that's great. Yeah, that's perfect. There are definitely questions on, can I see the trade details? Like I mentioned, go to NetPicks QuantiTrader.com after the webinar. There's all kinds of great information here on quant trading. There's performance summaries. You can go to margin portfolio. You can look at the equity curve, the evaluators, the monthly profit that I showed you. So, obviously you don't have access to that once the webinar is over, but it's all here. You can even click the trade details and see all the trades, longs and shorts, because I had some people asking, hey, can I see the short trades? So that's all here. And you can really get a good idea for, what the trades look like, what's the best results, what's the worst results, where did something crash and burn, where did it do phenomenally well. You can see kind of holding periods, like Jane mentioned, a lot of these 2, 3, 4 days. So this is always all going to follow exactly what she had mentioned. So this is all here for you, which is very cool. So it's an incredible amount of information at the NetPicks QuantiTrader site for you guys to do further research and further investigation. Okay, let's see. I'm just continuing to go through a lot of questions. I'm sure we're never going to get to all of them here today. We'll probably try to go another 5 or 10 minutes here. It's a good question from Joel. Explain a bit the difference in criteria between the margin account and the retirement account. Besides, of course, longs and shorts, we know that's one of the differences. But what other main difference?
They absolutely use the same logic for the longs. And then with the margin, of course, I have added the logic for the shorts. And Mark, if you want to go where you're showing here, if you go to performance, if you want to click on performance and go to performance summary and then over to margin and click on margin.
Margin portfolio right here?
Yeah, yep.
Okay.
And that will show you the long entry rules and it will show you the short entry rules. So that is so the difference between the two is there is not a lot of difference between as far as the long is concerned. This uses the same logic on the long because the long logic is just like blew my socks off when I started doing some testing on it. So I figured why not use the same logic. The thing is though that they do different in that I use a different pullback on both of them and I use a different N bar on both of them. And then of course the margin has the shorts, and I use a different number of positions in each as well. But you will see the same stocks on both. But it's sort of like scaling in because I use a different percentage pullback. I have a margin, and if you're trading both of them, you buy on one account, and then you buy at a different price on the different account. So you actually are like you're scaling in, and scaling in is just something in I've tested scaling in on algorithms before, and it is just a phenomenal way of entering a stock, but it gets kind of complicated on a service like this. So, but it is sort of like a quasi scaling in.
Great.
Does that make sense? Does that make sense? Good.
No, that was good. There were some questions on December and Christmas and everything, and I just wanted to point out just one thing Jane said, I think I've said, you really just kind of got to be consistent. I think if you start to try to cherry pick trades and days and start to get half-assed about it, you're not going to get the consistent results. Usually people that don't stick to a trade plan end up really doing poorly. Plus, you're going to just be so, the emotions when you're picking the wrong days, and how many times have you said, oh, I always kind of pick the wrong trade, and then as soon as I stop trading, the system gets hot. Well, don't put yourself in that position. Just take the setups as they occur based upon your start time and let the monthlies kind of do the work for you from there.
Absolutely.
Let's see.
There's a question here, Mark. What is N-bar stops? N-bar stops is the maximum number of days I will allow a trade to be open. If it doesn't do the dynamic stop, it will be an N-bar stop. That's what the N-bar means on the trades.
Great.
Okay.
Yep. Silvana, yes, you can place the trades the night before, the morning before the open. So that's something you definitely can do. That's probably what you'll want to do. Let me see. And like Jane mentioned, everything is limit-based. So even if the market gets a little sketchy around the open, unless you get your price, you're not going to get filled. So you don't have to worry about paying too much or getting a bad fill versus somebody else. I think we've answered the commission question quite a bit. Yeah, I know there were some people saying everybody must be clicking into the site won't come up. I think by now everybody who needed to get in should have been able to certainly get in. I'll put the link up again just for you guys. I saw a few of those. Yeah, it's holiday season. It's true, but I think this is a kind of a good time to sort of start to see things. And markets are still moving. They're still trading. There'll be obviously some very slow days right around the Christmas holiday, right around New Year's. But I think one thing that's kind of cool is January really kind of hits the ground running for a very good stretch of time. Usually it takes about a week or two after New Year's, and then things really start to kick into gear. So that's probably what I'd expect to see. No, you don't need any text alerts to your phone. We're not going to make you work hard and give you a text at 1 in the afternoon that you're going to go leave a meeting and I don't know, hop off the golf course and take care of business. You won't have to do that.
No, the market takes care of it for you.
Yeah, like we always say, let the market do what it's going to do. That's the key with this. I would even suggest don't be following your trades intraday. Just come in once every 24 hours and do your thing, see what happened. And leave it at that. You don't need to worry about any one specific trade. It's not going to matter. You saw that huge list of trades. Trust me, once you go through this for a few weeks or a couple months, you'd have so many trades. You won't even remember the trade you took a month ago. So it's not going to matter to you. Most retail traders have to pay much higher than $3 round trip. I think you should do a little more research, Bill, if that's the case. Interactive brokers might be a great place to look, and a lot of people have had to be very competitive with them. So I don't know. You shouldn't be paying a lot more than that. I mean, you may pay a little bit more than that, but if you're paying a lot more, you're probably overpaying. Boy, so many questions, Jane. I don't even know how we begin to answer all these. Let's see. Yeah, the results are based upon taking all trades. Obviously, it's possible you may miss some trades, and if you go on vacation, the nice thing is this is probably like one of those systems that you actually can do on a trip, work trip or vacation trip, because all you got to do is log in and place the trades and you're done. It's not like day trading, which is like impossible to do on a vacation or when you're traveling. But there may be a stretch where you just miss some trades, and sometimes that may work to your favor. Maybe the week you missed was down 2%. Maybe the week you missed is up 2%. I think as long as you're in there most of the time, you should be fine. I think what you don't want to do is week in and week out you trade. This week I traded Monday and Wednesday, and this week I traded Tuesday and Thursday. That's probably not a good thing. I just signed up. Free trial. Yeah, you'll definitely right. If you go to netpicks.com, the only thing it'll do is on that order form is it will be a free trial. The first 2 weeks will be free. You will need your cookies enabled on your browser. Yeah, if you get an error message, thanks, Joe, that is true. You will need that. No, you won't have. You shouldn't have, as far as we've seen, right? The pattern day trader situation, Jane. That's something that you have not encountered, correct?
Sorry, I had muted myself.
Oh, that's okay.
Okay.
It happens.
The pattern day trader, no,
Yeah.
You're never in and out of a stock on one day, so that is not an issue. Of course, if you make a mistake and you have to, like I have done, and you have to get out of a few stocks and then you get back in again, but that's not. But as far as the algorithm is concerned, no, pattern day trading is not an issue.
Okay, great. Yeah, so you guys should be able to get margin accounts. Obviously, with pattern day trading, they give you 4-to-1, but you're not going to use 4-to-1 with this. You definitely don't want to use 4-to-1 with this. Just you got to be aware of the drawdown side, and obviously we told you guys that's a key thing to be aware of at all times. Give me a second here. I know there was a couple questions on. Today you can see, I'll put it on the screen, there was very little to do, and there'll be some days like this, right, Jane, where there's a couple buys and a hold, and this is a lot shorter list than we even had yesterday.
Oh, right, yes. And I would like to mention that you probably are going to see this start to really compress in the next little while because it's now Christmas. And so I don't think there's going to be an awful lot of trades in the next little while. But as you can see what Mark is doing, he's scrolling through them, and you can see some of the trades that we have encountered in this month so far.
And of course, where you see no signals is just obviously the weekend. So you can go back a little bit and see some of the more previous or prior trades, and that's great. I guess that answers a little bit the Christmas question a bit too. That the model will just kick out less potential trades, and so
exactly
like today, it'll just be quiet.
But if you're first getting started on a system, I know you want to start trading, and you're probably not going to get an awful lot of trades in the next few days.
Sure. And that's another point. Just because there's only 2 setups, don't put 50% and 50%. Stick with the idea that you're supposed to keep, like you can see, 14% of your portfolio in the margin and 10%. So when you tell it how much you're working with, and you say, okay, $7,500, and I don't know, $10,000, it's going to calculate for you the number of shares. Stick with these shares. Don't, because you're so excited, load up on one of the trades because there's only 2 potential trades here. There'll be more tomorrow. There'll be more the next day. So
I just got a text from someone, and it said, "Mom, tell everyone the cookies must be on to sign up." So apparently, you need to turn your cookies on in order to sign up on the members only site.
Yeah, we did.
Okay.
Say that. Yeah, yep. Bill Miller says the website looks way better than Obamacare. So there's a compliment to Joe, who did all the programming.
Yes. I was telling my web developer, I said, what I do not want to have is a healthcare.gov experience here. So
that's funny. Yeah, good job. No, he did an amazing job, I got to say.
Yes, he did.
Very impressive. And I know you guys put a lot of effort into, you've told me several times, kind of that Steve Jobs approach of that simplicity, crisp and clean, and easy to use.
Yes, Joe Nakora is the fellow that did the development on this site, and he developed it in Java using a Cold Fusion server. Joe, I hope I said that right. But yeah, the members-only site was developed from the ground up. The .com site, the NetPicks QuantiTrader, was developed. I did that on WordPress, but the members-only site was developed in WordPress. In Java. So very stable.
Yeah, stable. It seems super fast, everything that we've seen. Now, with that said, there's going to be some people, we know you're going to have some issues, or maybe you didn't get your access, username, and password. I know I saw Brian in there. Make sure you check your spam or your junk folder. Could end up there. Check there, and then go ahead and make sure you whitelist from us. So you get the emails. You occasionally may get one from Jane. You're going to want to receive that. If you have issues, you see the email here, the phone number. We are here to help you. You guys know we'll work it through. Just with the number of people that probably got started today, there's going to be some things. So just let us know. If you had a sign-up problem, again, let us know. We'll make sure that we get you in there and get you in on the trial. We've been going for about an hour and a half. I realize there are some questions that are unanswered. Can you do me a favor? Shoot an email to us. Give us a chance to just respond to you one by one. What we're going to do is after the holiday, we're going to hold a Q&A session where we can just answer questions. I didn't want to do it during the Christmas week or the New Year's week, so right after the first of the year, we will schedule a Q&A with Jane, and we'll go ahead and be able to answer a lot more questions. Plus, I think that'll give a lot of you an opportunity to have really gone in there, maybe even have placed some trades, live or demo, and we plan on doing that on a very regular basis. So we can make sure you guys get all your questions answered at that time as well. Plus, we'll be sending out some emails here in the days ahead. We kind of talked about this, walkthroughs of the Owners Club, some more suggestions and advice, how to deal with the model, reminders of the performance, compounding. So keep an eye on that as well. We really want this to be an educational and a very positive experience for all of you. So, Jane, I think we really probably should wrap it up now. Any closing comments before we let everybody get on with their day?
Other than this is just about the most awesome system I've ever run into, and I've been trading full-time since 1999, and I love this I just more than what. This is my baby. So I think this is anybody that wants to trade equities, this is the only way to do it. 70% of the people on Wall Street have realized that trading with algorithms is the way to go. So now we may as well do it as well.
Yeah, I mean that's exactly right, and
and I want to thank everybody for coming today too. I just thank you very much for spending the hour and a half with us and letting Mark explain this so well, and I really appreciate your time.
No, thanks, Jane. I mean, we definitely can feel the passion and enthusiasm. That's why I've gotten so behind the project. You know, we hated to lose you when we lost you, but we knew that you were going to work on something that was going to be pretty special. So it took a few years, but it's certainly great to have you back and getting this into everybody's hands. And definitely a big thank you to all of you as well. I know a lot of people took some time out of your day. Hopefully we shared some good stuff with you, gave everybody a chance to certainly get the trial and get started. And just like I said, we're going to be here to work with you all in the coming days and weeks, and we realize that that's part of our responsibility. So contact information on the screen. Any problems, let us know. And that's it. Thank you again to everybody, and thanks to Brian and Will and Ron for helping with all the questions. And Jane, congratulations on doing such a great job, and you finally got your first webinar in. You did great.
I've been to many of them, but I've never been where I haven't actually had to talk.
There you go. You did fine.
Thank you very much for everybody, and I so appreciate the time that you spent with us.
Take care.
Take care.